We have Jiten Parmar who talk more about markets today from Aurum Capital. Jiten, thanks for joining us. We are chatting after a long time. First of all, I'd like to get your thoughts on this sharp rally which has happened, taking us to record highs on all benchmarks, and even people who were buyers of mid-cap names in the last couple of months are sitting on hefty profits. What are your thoughts? Is it time to book profits selectively, or is it good to ride and one should not be very, looking forward to really cut your profits so soon? It's a rising tide, we should ride it. What are your thoughts?
Yeah, good afternoon, Ajay, and happy Guru Purnima to all the viewers. So many gurus I've had over the years from whom I've learned. So, coming back to the topic on small caps and mid caps, yes, we have seen a sharp reversion from the start of this financial year. In the small cap index as well as in the product in the Nifty and the Sensex. See, what has happened is I think inflows have been very good, FII inflows, and if you see the data from mutual funds, a lot of inflows have happened into small and mid cap funds. So no, that is what is driving the rally. I believe from my talk with so many people across investors, I've seen that retail has been left behind, to be honest, and there is a lot of disbelief in this rally. And look at from from a 2-year perspective, we have just regained the highs. So in that sense, we remain positive on the markets. I don't know whether there will be some corrections in the future. They will always be there, but I think if you choose the right sectors and the right stocks, I think we should stay invested. So long term, we are very positive on retail markets.
Have you booked profit in any of your large positions, Jiten, after they've run up or valuations expanded?
Yes. So if you remember from our previous talks also over the years, we had entered into, let's say, something like capital goods, which has been a very good performer for us. And we have booked profits in some names there. But we remain constructive on the sector. Again, it's a case-by-case basis where risk reward might not be in favor and we have booked out. But that doesn't mean that, we are not positive on the sector. We continue to remain positive on the sector. But yes, we have booked out of some names purely from a risk reward perspective.
Okay. Let's also talk about some areas which are not doing a whole lot despite of a rally in the market. Chemical, API, this is one area. Pharma has already started moving up. How are you approaching these pockets?
So again, we have started investments in chemicals, agrotech, pharma APIs for the last few months already. And we believe that, these sectors had short-term headwinds, but long-term tailwinds are there for these sectors. For some of the sectors, we probably have, decadal runways. The whole issue was, specifically, let's say in chemicals, was that, post-COVID, the margins went up abnormally high, and street valued at on those margins. So basically, peak valuations, peak multiples at peak margins, and that's why we are seeing a good correction, very good correction in the chemical sector. As the margins came down over the last year or so. So FY23, we saw margin cuts across many names in chemicals. But I believe I think the pain could be there maybe for Q1 and a bit on Q2 also. But from second half, we should be doing well. Margin should normalize, and we also have to look at companies which have done capex and earnings will flow from there. So always look at normalized margins when valuing these companies. And from that aspect, we believe that some of these companies were at good valuations, and that's why we have started entering into these companies.
Jiten, a quick word. You speak with retail, HNI, all kinds of guys across the country. How are you reading the fabric of this rally? Is it very participative? Have people really been able to participate? Are the portfolios also at all-time high the way market are, or there's some section has actually been left behind, and that is why calling the top again and again?
Yeah, I think a lot of people have been left behind, to be honest. And you know, quite a few people I talk to don't have highs on their portfolios. The primary reason could be they could be in sectors which are not performing or which have had peaks some time back and could be in correction mode and so on. So the whole idea, what we focus on is also, what sectors to invest and what sectors to stay away from. We've had this talk about, avoiding sectors when we see, headwinds for a while. See, 1 or 2 quarters is fine for us. We can basically look at that. But if there are headwinds for a year or two or something, we kind of avoid those sectors and wait for opportunity.
I also want to understand from you your view on IT. Technology is something you understand very well. On the one hand, noises that how weak this quarter could be or another weak quarter lies ahead is getting louder. But fact of the matter is that IT index as well as many stocks between last quarter and this quarter itself are up 15-20%. In fact, analyzing portfolios of a lot of institutions actually tell you that there is buying in the last 2 months. So what's the right way of approaching technology, or are you looking at it?
No, at current valuations, we are not, to be honest. We still think there is pain ahead for some time. Frankly, I don't understand the rally. Maybe because the index has gone up, so the heavyweights from the index, and even surprisingly, the mid-cap IT has also gone up. But we believe that I think challenges are still there, and valuation just don't justify, at least for us to be invested in these companies. We do have, one IT product company which we initiated last year and which has done well. That is the area we like a bit more than IT services, to be honest.
Jiten, how would you approach realty and cement?
Yeah, I think cement FY23 was really bad, and I think FY24 will be significantly better. Though selling prices have not moved up significantly or stayed flat, what has happened is the input costs have come down significantly. So you will see, EBITDA per ton expanding in the current year. So we are very, very constructive on cement. And reality, see again, it came out of 8-year down cycle, and generally upcycle should last for a few years at least. So we remain positive on reality also.
Isn't valuation issue
sector, to be honest?
Isn't valuation an issue with some of the leading names now? Say, for example, Macrotech is at 100 times earnings. Isn't valuation becoming an issue, or you're finding names which are of lesser value?
So we will prefer to look at the mid caps in the sector. To be honest, the large caps just don't offer much value to us. To be honest, also it's a sector where I think the earnings will come after a few years. So one has to study, not look at quarterly numbers, that closely, but look at sales numbers and cash flow generation. That is what is more important.
Right. You're also quite famous among investors, Jiten, for your contra calls. What's your latest contra call you're forming?
Yeah, so as I said, we have looked at chemicals, API manufacturers, agri-tech. We've also recently entered sugar a few months back. Auxiliaries is something which we have entered over the last 1 year. Even auto companies. So these are some of the sectors which we have entered. Banking and financials is something which we continue to like, and we have been invested for a while, and we still think that there is still a lot of good times to come.
All right, Jiten, we'll let you go on that one. Thanks so much for joining us on the show today. That was Jiten Parmar of Aurum Capital talking about markets and the way they're approaching investing. Time for a short break. When we return, more news and analysis. Don't go anywhere.